Hello everyone, this is Chris. Welcome back to my channel. So let's start crafting this model with all the assumptions. In this class, we're going to build up the financial model for the revenue breakdown and also the operating expenditure breakdown. There's no discussion about the tax equity structure, which in this class will going to be very straightforward. It doesn't matter if it's US projects or European projects or China projects. The revenue buildup and the operating expenditure buildup are all the same logic. So let's start crafting on that. So we're gonna put a title, a P&L buildup. So remember one thing is when we actually build up doing the P&L buildup, it's always starting with the time flag. When we're starting with the time flag, it's always starting with the time flag is always starting with the beginning and also the operating period and the ending. The time flag is always like that. So let's see, the beginning of the project with start of the project, which is the COD, and operating PROD and ending period. So here is the flag. Okay. Later we can adjust the format, and here the starting of the project COD is basically for the size of for the starting construction of the project is not necessarily needed. Let me zoom in a little bit, changing into 130%, and then you're having that, and then starting of the projects, and we actually should put that in into January 1st. I'll simply do it here. Okay. And we should have an ending period. We're not putting an ending period here, but we're having a useful life. So let's do the calculation. It's going to be starting January 1st, 2024, and that's going to be 40 years, and you times the months per year, and you remember to minus 1. And so your ending projects period is going to be December 31st, 2063. And here is the ending period. Sorry. And then let's do the time flag. If we're always starting with the end. This one greater than that one, and this one smaller than the end of the projects, the end of the period. You're gonna have 1, otherwise it can be 0. And we want to have it, and let's change in that. Oops. So that's the time flag format. And also the second thing, always starting with if and if the smaller period is within the bigger period, that can be 1, otherwise that can be 0. So if this time period greater than within this one, and the bigger one within this one, so that's going to be 40 years. So see here, this is 40 years. And remember one thing, for the time flag, it's always starting with the if and function if you're having a periodic period like that. And also the format is very important. You just remember this format, and also starting with the start, operating, ending, that should be 0. And one element to mention is I have done put some airlock here. So in the later stage, if I need to make another time flag, because my format are all the same, so I can simply put copy paste. But for some of the candidates, if you are not familiar with the airlock function, you just build up each time by time and get familiar with that. So you can see end period is like that. So that's the operation period of the project, and then we can calculate the generation. For the generation part, we're gonna need the capacity, we're gonna need the P50 production yield, and we'll also need to build up the degradation, which is very important. So let's do the degradation first. Degradation. That is let me see, that I think it should be like 0.5%, right? Where I have put that. Is here. Okay. And for the degradation, let's assume the degradation happened in the very second of the year, and in the first year, the P50 production is already considered the first year degradation. So the degradation, and we put that into annually. So here as you can see, the second year you start the degradation, and here is a bit of incorrect, because in the last when the project ends, there should be no degradation. So you also want to times the operating period. Remember to make all your formulas consistent. Okay, so that's your degradation. I was wondering why. I think I should make that into 11, right? 10. Okay. Okay. Just make them into 10. Okay. And then let's have a degradation index, or we can name that into system efficiency. And we want that, we plus that, we minus the periodic degradation here. So starting from there, in the first year, you're having 100% system efficiency, and in the second year, you're having a 0.5% degradation. So that's your system efficiency index, and then we can do the calculation about the generation. So we're gonna have a generation calculation. I don't know why it's 011. Let's change that into 10. So format is very important. We're having a 20 megawatts project. We're having a generating hours in 2,000 hours, I think. P50 yield. So for P50 yield, it's always the base case for the investor, and the P90 yield is going to be the base case for the banker, for the banks. And see, so we're having 20 megawatts. We're having 2,000 hours annually. We're having system efficiency with the consideration of the degradation, and we will need to times the operating period time flag. So that's the generation. Ooh. I changed that into 10. So that's the generation, okay, which is very straightforward. I think I didn't miss any of the elements. So it should be megawatt hours, and then to build up the pricing. The pricing we're gonna have, we are having a two stream of revenue. The first 20 years we're gonna have a PPA revenue, which we sometimes term it as the contracted revenue, which the revenue or the cash flow is relatively stable because we're having an off-taker that is 100% taken with the confirmed price with even a very good escalation rate. And after the 20 years expire, the electricity gonna be sold to the merchant, the market, which is having a merchant exposure. So that's two parts. So we modelize the PPA first. So the always with the same practice, PPA start, TRT, PPA period, and PPA end. What we're having PPA start, it's just gonna be the, I think we have that in the PPA start here. This is PPA end. This is PPA start, and change that into date, and the PPA end. So that's the time flag format, and from the part above, we put it here. So that's the PPA, okay? And for the PPA, you're also having an escalation rate. PPA escalation at the amount of 2%. 2%. And also, so way to build up the PPA escalation index. The index here, we can to use the formula like, we can use that. Oops. I will need to make that down here. So as you can see, in the escalation rate, each year, starting from the second year, we're gonna have a 2% escalation all the way to the end of the PPA terms, and then we should have an index here. But thing is, oops, I don't know why there's a mismatch. The thing is, we need to change the formula a little bit. In the above example is no, in the above degradation is minus. Here we do the plus. So that's the PPA escalation. And some of the students may say, okay, based on the term, that should be 2% incremental based on the previous index. So here it's just pure plus 2%, which is not quite correct. So let's modify that a little bit. So it should be this one plus this one times 1 plus that one. Because that's the index, we make that into the figures. So here you can, as you can see, the second year is 102%. The third year is 104.04%. So that is, I think that should be correct. It's not should be correct. It is correct. And here is the PPA escalation, and then you're having a PPA price at the starting date of the project COD with the amount of $50 per megawatt hours. So that's the price, and then you're having a price. You're having a index times the PPA term. As you can see, by the end of the project, you're having a 72.84% of $84 per megawatt hours PPA price, and then your PPA expired. So that's your PPA pricing calculation. And also, since the first 20 years, 100% electricity generated going to be consumed by your off-taker, you can simply calculate the PPA revenue, which should be equals to $50 per megawatt hours times the 40,000 megawatt hours generated by the system, and that's the absolute total amount dollars you're going to receive each year. And here in this case, we want to show a current efficiency at 1,000. So we divide by 1,000, and here going to be USD 1,000. Okay. So that should be that's your revenue, and also same practice as the merchant. Let's do that. Changing all the PPA into merchant. Damn. I need to change those back to, you know. 1, 2, 3, 4, 5, 6, 7. Okay. Damn, why there's a T? Anyway, I'll do that manually. Here should be PPA price. PPA revenue. Okay. And for the merchant here, the starting date is going to be the end of the PPA plus 1. Sorry. Also the same practice. And the end date should be end of the project. Okay, and PPA merchant escalation, it is equals the same. It is 2%, but it's just 2% in this case, not always 2%. And index, you're gonna let's build up the index for the time flag index first. So here's the time flag. As you can see, starting from after the PPA expires, you can have a merchant revenue period flag, and all the way to the last day of the projects. So that's the merchant time flag. And for the escalation part, we can simply copy paste the formulas already have. Damn, I'm not having that. Okay. Oh, it's okay. I'm correct. I think I am correct. Okay. Anyway, here's the index. Okay. Let it be here. It's whatever. Okay. And here, merchant price part. The price is a bit of different. In our case, it is equals to the 75% the terminal value of the PPA. So, so the price here, we want to put 75% here, which is our underwriting. And let's do a sum product function here. That's going to be to calculate the terminal PPA value. So PPA ending price, end date as flag is here, and the pricing is here. So 72.84, that's your terminated PPA, and you times the 75%, that's the starting point of your merchant price. So it's 54.63, which in your cash flow you're gonna see, you know, a huge down in your cash flow because the price is decreasing into the merchant. And you times the escalation, you times the flag here. Okay. And you can see all the way here. Okay, and we want to leave some digit here, and the same rule. Anyway, I'm gonna use that times the your generation, you times the I think something is incorrect. Why? You don't need to, because I already have the generation here, and you divide it by 1000. So here is the revenue part of the merchant part, and we want to highlight that. And we to do a recap, PPA revenue, merchant revenue. PPA revenue is over there. Merchant revenue is over there. Okay, so that's the revenue breakdown, and you can have the total revenue calculated with some formatting. Okay, so that's your total revenue. So this is a revenue build up, which is very straightforward. And let's do the OPEX breakdown, which is even more straightforward. So for the OPEX here, let's have a quick recap. In the assumption, we're having 4 items: O&M, insurance, site lease, and others, pretty much like a placeholder. Another placeholder, but pretty much like other cost. And for each of the line items, we are having a 2% escalation rate. So let's make this very simple. We just assume there's only one escalation applied for all the OPEX, and we do the calculation. So the first thing is we to build up. We don't need to build up the time flag for the OPEX, because that's gonna across all the project life. We just starting with crafting the escalation. So the OPEX escalation rate is 2%. Let's just randomly take a 2% from the O&M part. And what we're gonna have? We're gonna have 2%. That's gonna be this one, and that's gonna be this one. The same practice like that. The second year you're gonna have 2%, right? And then you are having an O&M escalation index. For the index part, you can have here times this one times 1 plus this one. I don't know why it's I don't know why it is. Let me do this. So it's 2% annual incremental all the way to the end of the projects. Okay. Okay. And what we are gonna have, we're gonna have different items on fee. I think we are having an insurance cost. We're having a site leasing cost. We're also having other miscellaneous cost. For the O&M part, it's gonna be 10. I think something wrong with the unit here. It should be dollars per kilowatt instead of kilowatt per year. So let me change that. It should be dollars per kilowatt. All the same apply to the cost here. So it's 10. And the insurance part is 2.5. Site list part is 5. And you're having a other cost at 6. So let's see, you are having a $10 is dollars per kilowatt for this unit. I think I should here it should be US dollars 1,000. Okay. And so what's the cost? It's $10 per kilowatt. You times the capacity, which is 20 megawatts. 20 megawatts equals to 20,000 kilowatts. So you times 1,000. And also the same rule. Let me have an airlock here. Same rule times 1,000. Same rule is you know the currency unit is 1,000, so divided by 1,000. And remember, always the cash out should be negative figure. Otherwise, you're gonna mess up with the calculation. And we forget one part is the escalation index here. So, okay. Okay, something is incorrect. Okay. I need to airlock the index here. So that's the total operating expenditure. As you can see, it's going to be increasing all the time. And let's have a total OPEX. Total OPEX here. So you're having a total OPEX. Let me highlight that, and then you should be able to calculate your EBITDA, EBITDA here. That's gonna be equals to your total revenue plus the negative OPEX. You're having your annual EBITDA. So, and in US projects, more like EBITDA is operating cash flow because of the complicated deal structure. In the SPV, the real OpCo level is more like LLC. So there's not going to be a tax CIT applied in that level. Instead, it's going to be applied in the above level, in the tax entity and also the sponsors entity. So in the SPV level, the EBITDA is going to be more like the operating cash flow. So we're having the EBITDA. Let's calculate the EBITDA margin. Let's use the if air function and use the EBITDA divided by the total revenue. If air, there's nothing shown. And this is the EBITDA. In the EBITDA margin, because that's a matrix, so we change the format a little bit. And so that's basically the a simplified P&L build up. Instead of the P&L build up, it's more like an EBITDA build up. The reason is the depreciation going to be makers, and in the project level, in our case, we're not gonna have a debt at the project level case, and also all the tax analysis, as I mentioned, there's no CIT applied in the LLC, going to be or applied in the OpCo, it can be applied above. So that will be for the P&L build up. We do to the EBITDA, it should be okay. That's pretty much of this class. Thanks.